Today, we're going to be watching a video called How to Make Money in Stocks Trading Like a William O'Neill Disciple. So let's watch this together. Let's learn together and let's see if we can win big money bingo today, baby. Let's go.
Back. Today we look at the book Trade Like an O'Neill Disciple, featuring Dr. Katcher and Jill Moralez. Both traders previously worked under William O'Neill at William O'Neill & Co., and later generated thousands of percent by following William O'Neill's trading method. O'Neill is best known for his Can Slim strategy and the Investor's Business Daily newspaper. We look at the path both Moralez and Katcher took to earn such outstanding returns. The returns for Dr. Katcher reached over 18,000%, equating to a 110% annual return over a 7-year period between January 1996 to December 2002. In effect, turning a $10,000 investment into $1.8 million.
I mean, that sounds okay. That sounds okay. Hey, as we go through, if you see anything on Big Money Bingo board over here, put it in the chat, like into don't buy the dip type of situation, because I'm pretty sure we'll get at least one bingo today, maybe several.
Classed as William O'Neill's right-hand research man, Katcher examined years of stock behavior through more than 20 market cycles going all the way back to the 1920s. He came up with a list of criteria which all the best performing stocks shared, whilst also creating a market timing tool which has been accurate since 1974. From his research and subsequent application, Katcher suggests that making big gains in the market need not be difficult, and continues by saying, in the end, it is about working hard to put yourself in the position of being
I see a lot of B5s coming through. I must have missed it. What was? Oh, did he say market cycle? Sweet. Let's go.
the right place at the right time. That is, when a leading stock is...
Oh, crap. My bad. Hang on. Click the wrong button. I was trying to get this to collapse. Why is it not collapsing? There we go.
just starting a huge upside price run. The quote gives us a flavor of Katcher's philosophy, which is supported by his first investment back in 1996 through a technology company called iOmega.
Hold tight. Being in the right place, right time. When a leading stock is just starting a huge upside price run. Where is Let Your Winners Run? I'm going to give you that one right there for that. I will absolutely give you Let Your Winners Run right there. So, couple things to note as we go through. Right. You can also grab this book. I have it as well. Where is it at? The orange book. Here. Hold on. Sorry, I got to move all my Christmas decorations out of the way. Here we go. How to Make Money in Stocks. You also can grab this book. Honestly, probably really cheap. There's a lot in this book, right, that you don't need to know. I'll be very 100% transparent and honest with you. There's a lot in this you don't need to know. I mean, it's super thick. However, the first 100 pages or so, let me pull this up here. The first 100 pages or so are all charts marking up all these amazing entry points and things like that. Now, what I want you to realize as you go through this book, as you have it, type a 1 in the chat if you do have it. I'm curious how many of you have this book in the chat versus how many of you don't, right? As you go through this, notice one thing. One thing you'll notice right here. All these markings and things like that on them, right? What are they all doing? Are they crashing down? Are you getting paid when you buy the dip? No, of course not. You're only getting paid as the price is going up. They're all going up at a 45-degree angle up and to the right. And still people want to say, buy the dip, be a long-term investor. No, not at all. You don't want to do either of those things. You want to be in when a stock is crashing up and out of the way as it's crashing down. The 10 is over the 20, price is over the 50. That, my friends, is how you know it's a bullish trend. Makes it super easy when you know that, right? Super simple, 100% for free. You can take that to your grave. Every time a stock is trending up, the 10 will be over the 20, price will be over the 50. That is the easiest identifiable trend you will ever come across.
The stock saw a 700% increase in earnings and a 287% increase in sales.
Okay.
And as a result,
as we talked about in this book, lots of things that you don't need to know. Lots of things you don't need to know. I don't care how much their earnings have gone up. I don't care how much their sales have gone up. Do earnings and sales have any difference to me whatsoever in my portfolio? No, not at all. I personally am caring about making sure I get paid. I don't care if the company's getting paid. I don't care at all. You could have the worst company in the world, yet the stock price is running like crazy. You can have the best company of all time, and the stock price is crashing, right? These fundamentals don't matter. What matters is, are you getting paid through price? That right there, my friends, is what you're looking for. So these type of things, like I say, most of that book you don't need to know, because these are meaningless to the end the end of the day bottom line in your account.
The stock price broke through a significant line of resistance, although failed to break through the 200-day moving average. This created a new line of resistance, and in mid-March, price broke through both the resistance and the 200-day moving.
Now, I would bet you that iOmega had order blocks right here. This is one of the reasons why we don't trade running into order blocks, right? Because when areas of strong turns happen, those become areas of support and resistance. And it can take weeks, months, or years to chew through all of these sell orders right here. Now, why would I say that there's order blocks there? Because look at the resistance, right? Every time somebody got back to break even, they were looking to close as fast as they possibly could. When you break through those points of resistance, get through those order blocks, then gangbusters. Now, granted, the Orange Book was made before order blocks were a thing, but they're real, super real.
moving average with considerable volume.
Oh, he did say breakout. Thank you guys very much. Carol Catherine, it's good to see you. Carol Catherine, great to see you. Carol Catherine's one of our long timers. Great to see you, Carol.
Katcher proceeded to take a trade at the breakout with a 25% position size against his trading account. The criteria he used is not groundbreaking. The best traders look for a catalyst, which is often found from increases in earnings or sales. The same applies to the technical criteria, with most looking for breakouts of resistance with price trading above the 200-day moving average on
There
increased
you go. Price over any moving average. I'll give you that.
volume. The approach is clearly aligned to that of William O'Neill's hybrid method, which looks for fundamentals in combination with specific technical criteria, often referred to as a techno-fundamental approach. Katcher also provided a chart which gave reason to sell his position in iOmega. He notes that the stock
Wait. What do you mean sell? I thought you held stocks forever. I thought if you were going to buy a stock, you have to hold it for the rest of time, right? Wait, are you telling me that you can have a reason to get out of a stock? Wait. This random guy on the internet told me I need to buy stocks as they're crashing up, not buy the dip. But what about on this side? How do I get out? Use your 10 over 20 price over 50 right there. These are not the 10 over 20 price over 50, by the way. Those are much longer term moving averages. But I can guarantee you that the top happened right around here when the 10, in fact, let's get my colors correct. When the blue line looks something like this, the red line, I'm sorry, the black line, that's my 20 period moving average, looks something like this. And then the 50 period looks something like this. Right? And if that happened on your chart, boom, there's no way that you need to be holding a type of signal right there. Right there. Nate's trying to get us to say buy the dip. Fine, Nate, I'll give it to you. I'll give it to you just because I know Nate. Nate's a good guy. So therefore, you guys owe one for Nate.
price closed below its 10-day moving average, a rule he uses for most of his positions. The trade eventually provided a return of close to 200% over a 3-month period. Katcher suggests having such a sell rule.
Okay, this is a great point right here. What is my delicious representation of how much money you can make in the meantime? What is my delicious representation? Hang on. Looking for it in the chat. Brisket, baby. Let's go. Brisket sandwiches. Yeah. Brisket sandwiches. All right. So what do I mean by that? This is a great example of how to trade. Right? Imagine that you just went to your favorite barbecue joint. Maybe you went to Hutchins Barbecue in Texas, right? I grew up with the Hutchins family. They were actually my babysitters. Now they have like one of the most popular barbecue joints in the North Dallas area. Which is really funny because I would go to the Hutchins Barbecue joint back when I was like 6 years old, and I remember their original store. They had a window where you'd put your tray into, and I just thought it was so fun because I was like, it's just like I'm at school, right? My 6-year-old self, it's like I'm at school, but I get to eat barbecue. Yeah, I've known the Hutchins people for 40 years at this point, basically. But this brisket sandwich right here, right? Look at this. You don't care about the bottom, right? This is the bun. This is the top bun. This is the bottom bun. You don't care about that. You're never going to catch the bottom and you're never going to catch the top. But what you can do is make so much money on the 80% in the middle. So imagine you don't roll up into Hutchins Barbecue. Hang on. Somebody said they know Hutchins. Yeah, Jiggly knows some Hutchins. You don't roll up into Hutchins Barbecue and say, "Give me bread, please." No, you can go to HEB, you can go to Walmart, you can go to Kroger, you can go to anywhere and get your bread. But if you want the stuff that they are known for, that's what you're there for, right? You don't walk up into the barbecue joint looking for bread. You walk up in the barbecue joint looking for the brisket sandwich. And where I'm trying to go with that long example is you're never going to catch the top, you're never going to catch the bottom, but you can make so much money in the middle. So much money in the meantime. That is your goal. Find a stock that's working. Ignore the fact that you didn't catch the bottom. Run it as far as it'll go. At some point, it will tell you when it's stopping going up. And then you can get out and keep all of that juicy profit in the middle. Isn't that cool? It is a great, hopefully, I think it's a great analogy. You might not think so, but I think it's a great analogy to realize our goal is not to catch the entirety of the move. Our goal is to catch the 80% in the middle, or in this case, the 200% in the middle. So I will give you entry and exit signals right there because it literally says buy point. So I'll give you that as a entry signal. Let's keep going.
In place can take the emotion and subjectivity out of trading. He says, buy based on both fundamentals and technicals, but sell purely on technical. Technical action should always be the final judge when selling a stock. Between March and final judge when selling a stock.
Okay, again, and I really appreciate this so much. There's so much in the orange book that doesn't matter. Because he just told you right here, you're only getting paid by the price. Profits follow price. I used to say something else, but I can't say it anymore. I'm not going to stop you from saying it in the chat, but I have a cease and desist order that I can't say that anymore. You're only going to get paid when profits follow the price. Technical action, aka price action, should always be the final judge when selling a stock. Follow the price.
Between March and June 1996, following similar methodology, Katcher found himself holding between 12 and 18 positions on full margin. He often used between 15 to 25% of his trading equity per position, therefore his use of margin would have been a maximum 4.5, so for every $1 of equity, he could have been controlling up to $4.5. If we use his average position size of 20%,
See lots of people saying I4. I'll give you I4.
against 15 positions, it's likely he would have been using a margin of 3, or for every $1 of equity, he would be controlling a more reasonable $3 of stock. In my opinion, use of such high leverage requires significant levels of cash reserves or exceptional risk management. Ideally, both. Katcher's 18 positions were also heavily weighted with stocks displaying the cup and handle setup, a strategy we covered in previous videos.
Okay, there you go. You don't want to be buying the dip. Now, your moving averages are going to turn down at this point, right? And I'm not a huge, I shouldn't say believer. I'm not a huge follower of patterns because patterns are super subjective. There's probably one in every 1,000 of these patterns that actually fits like this. The rest of the time, you're just trying to make it fit that, right? However, point being is that you can make so much money on the way up. You don't have to be looking for anything like that. You can make so much money on the way up. And then it could have its pullback, and then you make so much money again. I wonder, there's probably a stock out there I could use as an example. Maybe SoFi, the greatest stock in the history of mankind. The greatest stock in the history of mankind, right? Again, you could make so much money on the way up. Get out of the way as it contracts. And I'm sure somebody's going to say, there's no way that's a cup and handle. I don't care. I don't look for that. I don't look for patterns. I'm just telling you, you could make so much money on its way up, get out of the way as it pulls back, and in this case it went down 53%, and then you can get back in and make so much money on the way back up a second time. Pretty cool, right? SoFi is the perfect stock. All stocks are bad except for SoFi. It can't be bad at all. No way.
To recap, during a correction or under the weight of a downtrending market, the left-hand side of the cup is often formed, classed as such by a minimum prior advance of 30%. The forming of a double bottom at the base of the cup is often a defining characteristic. Once the weight of the overall market disappears, leading stocks start to appear.
Hang on. You kind of glanced over that, but the weight of the overall market disappearing. Remember, 40% of your move is due to the market, 30% due to the sector, and the last 30% due to the stock itself. So when you remove that 40% bear market, in this case, weight off of it, that lightens the load and you can rocket ship out of there. That goes back to our one of our fundamentals we talk about. Fundamentals. One of our principles that we talk about all the time.
Bounding to levels where they were heading before the tide of the market took hold, whilst forming the right-hand side of the cup. A retracement prior to an eventual break of resistance offers an excellent place for stop loss, just below the pivot point. Other defining characteristics consider the depth of the cup, which should range between 12 and 33%, and the base of the cup, which can be between 7 and 65 weeks. A considerable increase of volume through the pivot point is also desirable. These low-risk, high-reward cup and handle patterns enabled Katcher to build a portfolio of high-quality, leading stocks with considerable leverage.
You're saying G1? I don't think he said G1, did he? Did he actually say G1, use the stop loss? Oh, he did. Yeah. Put your stop loss under the pivot point. For sure. By the way, we are going to give away some Christmas merch here in just a moment. The way to enter for the giveaway is putting hashtag outlier in the chat. Now, you should double check. I don't know. I don't know who's included in this list right now. I have no idea. So you don't want to be excluded. You don't want to be left out, right? So you need to put hashtag outlier in the chat just to make sure. Like Mikey the Yank and Cam, put hashtag outlier in the chat right now just to make sure that your entry is actually in the system.
At the end of June, after accumulating his portfolio, Katcher soon found himself in a 100% cash position, after all the positions triggered
Wait, what? A 100% cash position?
his 10-day moving average sell rule.
10-day moving average sell rule? Wow, it's almost like this guy and me know what we're talking about here. You wait in cash after, and this is the deal, right? And this is where I'm at as of today, as of this recording. I'm 100% in the market. However, I'm going to get sell signals at some point, and then I'll start picking them off one by one, and potentially I could get 100% out of the market. At that point, what do? I'll tell you what you do. You don't act like Derpy Joker and go trading anything, right? No, we don't do that around here. No. Outliers understand that when there are not trades to be made, you sit in cash and you don't F up your portfolio, okay? Derpy Joker's over here on your left shoulder, and he's like, hey, go F up your portfolio. Hey, I heard SoFi is the single greatest stock of all time. You need to make sure. I need to come up with the Derpy Joker voice. Hang on. I don't know if I'll get to it today, but just imagine how much more money you'd make if you bought SoFi today, even though everything in your trading plan is telling you not to buy any stocks. You need to go buy some right now, huh? Why so serious, huh? I don't know, I'll come up with a Derpy Joker voice, but that's the point, right? Getting out of the way, don't screwing up your portfolio.
Soon after, the indexes started to fall, with the Nasdaq index falling 20%. Named the Dr. K's market direction model, Katcher describes how he timed and re-entered the market in early August 1996, a tactic he developed through his years of research and endorsed by William O'Neill.
Wait a minute. I thought we needed the cup and the handle. I thought we needed the cup and the handle. This doesn't look like a cup and a handle. I'm not a huge pattern guy, as you can tell. But, right, moving average looks like 50. He's got a 10, 20, 50, and 200. So this is your 10, the very, very, very faint gray line. This is your 20, the very slightly less faint gray line. And then your 50 is here. This is your 50, okay? This is the 200. Guess where the frick you should be buying? Can anybody see that right there? Anybody see where I'd be buying right here? This here, I'm going to draw on this to make it a bit easier. Blue is the 10. This is my 10 EMA color is the blue line, okay? Black is the 20 here. And then red is the 50. Oh, that's not red. Red is the 50. Red is the 50. Where was the buy point right there? Looks really obvious to Chris. It looks as obvious AF. Your 10 going over the 20, price going over the 50. Right there. Your 10 over the 20, price over the 50, rocket ships. It looks obvious as possible. And you don't need 600 pages of learning fundamentals at all when you can see right there the 10 going over the 20, price going over the 50. Pretty crazy, right? Gangbusters. And I'm not looking for patterns or anything like that. I'm just looking for mathematical certainty of your short term, intermediate term, and long term moving together. Now, here's the thing. We don't know it's going to do this. We have no idea that it's going to do this. To say that it's going to do this every time is absolutely a falsity. But every time it does this, for sure, your 10 goes over the 20, price goes over the 50. Pretty cool, right?
Went on to say, "Don't ever let anyone tell you that you can't time the market. This is a giant myth passed on mainly by Wall Street, the media, and those who have never been able to do it, so they think it's impossible." Let's
Oh,
look at
I
the criteria.
love this video. Don't ever let anyone tell you you can't time the market. The people who say you can't time the market are the people who are trying to make sure that you invest with them, make sure you put your money with them so that they can tell you, listen, get your 6 to 8% returns forever and just be okay with that. Those are the ones who are trying to get you to believe that you will never be able to beat the market. Just take your 6 to 8% returns like every other sheep out there and go away.
Criteria for Dr. Katcher's timing model and how he used it to re-enter the market on the long side after a market correction. Using a major index, first we need to see a rally attempt off the lows. We can see there were 2 rally attempts. The first was seen in July. It was classed as a qualifying rally attempt due to price closing lower against the previous day, accompanied by the closing price being within the top half of the day on increasing volume. This rally attempt is a signal of potential supporting action off the lows. The next action to look for is a follow-through day. A follow-through is determined by an increase in price of more than 1.5% from the previous day, with an increase in volume from the previous day. We can see in this first rally attempt that although price achieved a 1.5% gain on the previous day, the volume was less than the previous day. This resulted in a failed rally attempt. The next qualifying rally attempt appeared later in July. However, the first follow-through attempt failed due to volume again being less than the day prior. A few days later, the market increased by at least 1.5%, and this time it was accompanied by an increase in volume from the previous day.
So, interesting point. I'm going to put this out there. Some of you are going to say I'm right. Some of you are going to say I'm wrong. That's okay. This is my trading plan. I don't look at volume. I don't look at volume at all. Like when I say I don't look at volume, like I do not look at volume. But some people do, and that's totally fine. By the way, DeHammer. So there was a huge Thanksgiving debate. Turkey and stuffing and cranberry sauce was thrown in anger because his brother-in-law, that son of a gun, how dare he marry your sister? How you can't time the market or get out before the market crashes. Well, you go tell the derpy joker brother-in-law that you are unfortunately related to, that a random guy on the internet has proved time and time and time again that you can get out of the way before every single market crash in history. Every single market crash in history had the 10 go under the 20, price go under the 50 before the crash. Now, were you at the very top? No, I'm not saying you will, but you will definitely be out of the way before the big, nasty, scary move down.
It was therefore a qualifying signal to re-enter the market with qualifying positions. Katcher continued to buy individual stocks, which again met his techno-fundamental criteria, and ended 1996 with a return of over 121%. He said, as a general rule, following the method of buying fundamentally strong stocks at the right pivot points, then moving to cash when the market is weak, puts the odds greatly in your favor. I tested the timing model against the S&P 500 index during the recent pandemic crash of 2020. It's likely we would have been put into a 100% cash position due to the positions crossing below the 10-day moving average. At this stage...
Hold on. Wait a minute. He might be about to explain what Chris talks about.
We look for a re-entry based on the timing model. First, we look for a rally attempt. In late February, we see the first rally bar, defined by price closing below the previous day and closing within the top half of the trading day. Next, we look for a follow-through day of at least 1.5%, which we get, although the volume is less than the previous day and therefore the signal is not valid. The next
Don't worry about volume. I mean, honestly, if you were to look at this, you know exactly what you see. You would see the 10, the 20, and the 50 look something like that, right? So don't touch anything on the way down. You're just waiting for the right side, right? You're waiting on the right side for the stocks to be crashing up, not as they're crashing down. You don't have to look at a volume bar. You don't have to look at anything like this, right? In fact, somebody in the chat was talking about, just a moment here. I want to find it. Here we go. Zen Trend Trader says there's so much legwork when it comes to CanSim. It consumes your nights and weekends studying charts. I need a plan with social life. I agree with you. OVTLYR is like literally 82 cents a day, but but I don't know.
next rally attempt is seen a few weeks later in March. The bar has arguably closed within the top half of the trading day, followed by a follow-through day greater than 1.5%, and this time with greater volume than the previous day. This could have been a valid signal and a time to build a portfolio of qualifying stocks. Jill Moralez, under the same mentor as Dr. Katcher, took a similar path, applying the same principles. In this example, he takes us through his Oracle Corp trade. Using the weekly chart, we are presented with a cup and handle formation, a resistance line, and a breakout, which signaled the first entry.
Just want to look at this real quick, right? So this is weekly charts, but this 10 over 20 price over 50 applies to weekly or daily. It doesn't matter, or 5 minute or 1 minute. It doesn't matter at all, because the principles are always the same, right? You could have got in, made money all the way up, got out over here, and then did it again. You don't have to wait for this, right? How long would you have? Let's say you found Oracle back in September of 1998. It's running like gangbusters, and you're like, no. I'm waiting for the cup with handle. I'm waiting for the pullback before I'm interested to get in. And you lost how many hundreds of percents of gains? Then it pulls back, and you're like, oh, freaking finally, let's go. But then you had to wait from February until September. So basically, you're talking about an entire calendar year from the point you identified a setup to the point where you got in. Ain't nobody got time for that. Ain't nobody got time for that. But you do have time to follow the trend. I'm just saying. You got time to follow the trend. And you definitely have time to wait with consistency and discipline. Oh my goodness, we finally got our first bingo. Let's go, baby. Bingo number 1. All right, we finally got our first bingo on the board. We are good to go. Let's keep going.
Entry. If we overlay the following chart, we can see the entry point and trade progression.
Again,
The
same
first
thing, right? Could have made money here, got out of the way. Maybe made some money here, got out of the way. Maybe made some money here, got out of the way. And you could have made a buttload of money over here, right? Buy stocks as they're crashing up.
first entry at the break of resistance from the cup and handle formation is seen here. It came after some tight consolidation with an increase in volume. Several weeks later, the stock again consolidated and formed what Moralez referred to as a base-on-base formation. The stock again broke out of consolidation through resistance and on significant volume, making new highs thereafter. Moralez took a near 250% return in just 3 months.
Let's go. 250% return in 3 months is bonkers.
Referring to his Oracle trade, Moralez said, "The idea that stocks that try to break out before the general market has finished correcting and turning back to the upside are often your strongest buy candidates once the market actually does begin a new uptrend." In summary, the strategies of Dr. Katcher and Moralez are naturally aligned to William O'Neill's. Both look for quality stocks, often showing increases in earnings and sales, and like most successful traders, they look for breakouts on volume in the direction of the trend, often determined by the 200-day moving average.
Hold on. We need more bingos on this because we're about to wrap the video. You got to be high. You have to get higher highs. There's no possible way you're making money at any point on these charts without it getting higher highs. Let's see. You got to cut your losses, right? They didn't specifically talk about that. Honestly, it was all about the how to make more money, not how to reduce your risk. But I'll give you that. You You know what? No, I won't. I won't give you that one because he didn't really talk about that. He talked about the sexy side of trading, but he didn't talk about the real side of trading. So I'm not going to give you that one. Let's see. He definitely was talking about having high probability setups. Yeah, that's basically what everything was all about today was high probability setups. And you know, one thing he was talking about, he didn't specifically state it, but when the market's moving with you, the sector's moving with you, and the stock's moving with you, you have tons of momentum, which gives us another bingo. Let's go. I am very surprised. Ultra surprised. Only 2 bingos out of that. Super duper surprised. But you know what I'm not surprised about is the fact that you guys put hashtag outlier in the chat because you want to win some bingo. Yeah, we're going to give away some holiday merch, only holiday merch today because we only have a couple days left to make sure that we get this to you before the end of the year. Where is my, there it is. Only a few days left to get this to you before the end of the year. So let's see who the first bingo winner is going to be. By the way, if an Outlier University student pulls up here, they get to pick anything they want. That's my new rule. All right, so let's see who our first winner is. First winner is, wait a minute. One of the Sith has won? This is not cool. No. The force is dark with this one here. Sithru, how dare you? My friend, this is all the light side. 2 there are, never more, never less, of the Sith. But you know what, Sithru? I will let you, just for this one time only, win Big Money Bingo. Let's see what the Sith has won today. He has won a Outlier Holiday 2025 Special Edition small shirt. Small just meaning the logo, not the size. Don't worry, Sithru. We'll get you the right size. But the small shirt right there. Congratulations to you, Mr. Sithru. Holiday shirt small. So I'm emailing April and Cheryl. They will take care of you. For all of our winners, all you got to do is email into support@outlier.com to claim your prize. So congratulations to Sith, even though he is on the dark side. I'll let it go this one time. Let's keep going. Let's see who our second bingo is. Maybe Mikey the Yank will win finally. Let's see who the winner is going to be here. Litofs. There we go. Litofs. It can't be anything except Litofs. There's no way that I'm saying this wrong. Litofs. Let's see what Litofs has won. Let's see what an ad was removed. Oh man. I love spinning the Wheel of Fortune and getting ads. Let's see what Litofs has won. Neuther options. Let's see what Litofs has won. Oh, a special edition packable jacket. These jackets are great. I own one as well. Mine has the Outlier flag on it, but Litofs is going to have the special holiday edition one. Very cool. So Litofs gets the special holiday edition jacket. Very cool. Congratulations to Mr. Sith and Mr. Litofs, and congratulations to you, because if you're ready to save time, make money, start winning with less risk, click one of these 2 videos, and we will talk soon.